So the key to success, what I've educated clients over the years is you got to have that discipline. Asset allocation is the discipline, which lets you buy low. You add to your losers at the cost of selling your winners. And that's the rotation. Now, it's not 100% in and 100% out. It's pruning a tree.
Welcome back to the Money Seed Podcast. My guest today is Bruce Weinstein, better known as the Planman. Bruce, welcome to the show.
Thank you, Gabe. Pleasure to be here.
Bruce, you are a financial expert, a planning specialist, and a fellow podcaster. Tell us, how did you get the name Planman?
Oh, man. I think somewhat self-anointed. I've been doing planning before planning was ever in vogue. I used to be teased way back when. We talked a little bit. I started in 1986 as a stockbroker at Merrill Lynch. And it's sad to say, but, we used to get bitched at by management is I don't pay you to think, I pay you to sell. And a lot of times that came from because they would say, how come you're not putting your client in this? And how come you're not putting your client in that? And I would say, well, I don't think it's right for Gabe. Because I had asked Gabe questions and I was trying to find the appropriate investments for him in his situation. And they used to bark at us like, we don't pay you to think, we pay you to sell. And they wanted us to sell their garbage. So early on, before planning was ever an in vogue name, not into probably the mid-late 90s did everybody start catching up and doing planning. And 2011, I passed my certified financial planner test and exam. But yeah, somewhere along the way, my license plate in New Jersey said Planman. I think if you see it, it's still behind me there. And my plate in Florida has it. So when I was thinking of a name for the show, I was kind of like, well, come ask the Planman. Like, why not? Like, let's talk to the Planman. So he's always got some ideas.
And what kind of plans do you typically make?
Well, financial planning in general, if you look at what the certified financial planner's guide is pretty much 6 areas into the financial plan area. And so you're breaking that down, and not all of that is really necessarily our forte, because tax planning is in there, estate planning is in there, but it's college, retirement, budget, cash flow, insurance. So all of these pieces intertwine with each other. So depending on people's stage of life and their goals, the big steps in the planning process is data gathering and information. And the more you know, the more dangerous you can become. And the way I like to describe planning, like, well, what's the point? What do I need it for? Is you said you're in San Francisco. I grew up in New Jersey. I live in Florida. So we're by water, right? You grew up around water. Most listeners have grown around a lake, a pond, a stream, whatever. Have you ever flipped a rock into the water and watch it skim across? Okay.
Yeah.
So what happens to those wavelengths, if you will, when the rock hits, is you see the shimmer of the water as the rock glides across and the waves continue out. Well, I use that as, well, that's what a financial plan does, is the plan is showing you where that ripple is taking you from where you are today with all the resources you have available. And we're going to look into that ripple. And if you don't like where the ripple's stopping, well, I can't go back 5 years. I can't go back 20 years. You should have bought Apple at the IPO, right? No, you have to start today. All we can do is fix things from today. And so the plan shows you how and what to address to get you on the track that you wanted to. So if you don't want it to go out into the left side of the stream and you wanted to go to the right side of the stream, well, you start throwing rocks to the right. So same thing there is, what do I need to do differently with that information? Make sense?
Absolutely. So let's talk about, I guess, maybe 4 of the most common ones, right? One is like, you can talk about tax planning, retirement planning, estate planning, etc. But when you see your clients, what would you say are the biggest mistakes people make, or where are people leaving money on the table?
Well, I think at its core, start with budget. Cash flow and budget, poor use of money, leveraged use of money, credit cards and debt. So you can't have discretionary capital to invest until you figure out your budget and your means and your lifestyle and are willing to do what you need to do to stay within that budget. So if you want to buy rental property, if you want to put money into stocks, bonds, mutual funds, where does that money come from? And so where you're generating it and why a lot of people don't do it when they start getting that first job and they see taxes come out and expenses for health insurance and other things. And then like, well, I got a car payment. I got the cell phone payments never go away, right? You keep upgrading your phone every 2 years and that payment keeps staying there. They got you suckered into that one. Converting from car purchases to car leases keep you on the hook for a longer time. So where does the cash flow come from to do what you're talking about to your investor community, right? So first and foremost there. So you got to have the means, you got to have the budget. And again, the planning, think of Stephen Covey, begin with the end in mind. If you want to retire at 50 with $150,000 of tax-free income, passively or otherwise, well, what does that add up to? How do you get there? How does that 22-year-old, 30-year-old get there? And can they get there by the age of 50? Well, what if it's age 55? What if it's 60? What if you need to save $15,000 a month? I don't have $15,000 a month. Well, what do you have? I have 5. Okay, well, what is that? So everything is a lever, and so it's a push-pull. And so what I like to describe to my client is, Gabe, you control 3 things. You control the amount of money you save and spend, meaning your budget, now and in retirement. 2, your timeline. When do you want to get to that goal? Retirement, we just use retirement. So 60, 58, 62, 70, whatever it is. The third thing is the rate of return on your money. If you are a bond investor and you're making 5 or 6%, if you're a CD investor and you're making 3 or 4%, if you're a real estate investor and you're making 12%, if you're buying stocks, whatever it is. So your rate of return, that your risk tolerance dictates your rate of return. So those 3 things, let me just repeat it real quick. So it's the budget, right? The money in, the money out, how much you save and how much you could save realistically, right? Mm-hmm. So it leads to what you need, the timeline and the rate of return. Which of these are non-negotiable? Which of these are non-negotiable?
I would say the timeline is probably the one that's going to get you.
Again, your decision, right? So if your timeline is non-negotiable, are you willing to do the things that are needed to be done? What if you need to make 32% rates of return? Is that achievable? No. What if you have to live on $800 a month and in retirement, you'll have what you need? Are you willing to live on $800 a month for the next 15 years? Probably not, right?
Yeah, you're right. In that case, the timeline kind of speaks for itself, and I might have to work until I'm 75 if I'm in that situation.
Right. So that the timelines, so the 3 pieces are interchangeable, right? And so you have to massage them to make it work. And then eventually, look, the little old lady that's a CD investor, you're not going to convince her to go buy and write covered calls and, buy gold and Bitcoin. She's a CD investor. So then the conversation is, if you want to reach these goals or never run out of money being a CD investor, this is how much you can live on, right? This is when you can stop working, or this, more importantly, this is when you're going to start running out of money. You want to know that information now, right, before you flip the switch to retire. So yeah, she might be able to get to retire at 62, but all of a sudden at 77, she's out of money. Well, now what? And that's what the planning shows, right? That's where we're pulling back the onion, right? The Monty Hall and, show me door number 3. You're showing people what's behind the curtain. And then you're giving them guidance, advice on how to massage that clay into something hopefully more formidable for themselves.
A few minutes ago, you mentioned covered calls. What type of investments do you mention to your clients, right? I mean, let's say you sit down with your client, they do the plan, and you're like, oh, you know what? Like, the numbers don't add up. And now you're going to have to sacrifice one of those 3 things. And let's say in your financial model, you had the average typical 7% or 8% rate of return that most people get when they dump their money into a managed mutual fund, et cetera.
Right.
What kind of investments do you mention to your clients or recommend to your clients that are like maybe 10 or 15% or can reliably get you a higher rate of return?
Well, these days I'm not giving investment advice for sale, right? So I now partner with that investment advisor. So we'll do the planning. I'll do the education. I can implement the insurance. I do fixed and indexed annuities. You mentioned offline infinite banking, stuff like that. So, we use life insurance and annuities for strategies along the way. But in the old days, when I was licensed and was doing implementation, I was very big on asset allocation, which manages risk. The financial plan backs into a rate of return that the clients ultimately have to accept or buy into. So if I said to you, Gabe, you could retire at 62, you can have, we're making up numbers, folks, $10,000 a month to live on, and you could reach all your goals and objectives, never run out of money. You need to make a 9% rate of return between now and then and into retirement years. Now that sounds great, but the question is, what do I need to put my money into to make 9%? Because we're just giving a number. And then the education comes into asset allocation, which is risk modeling. It's trying to balance a portfolio between, let's just say, cash, stocks, bonds, gold. Well, what type of stocks? What type of bonds? Large cap, mid cap, small cap, international. What about value versus growth? So how much goes into each of those buckets gives you a model of performance and return, and you're trying to keep your risk down. So as an example, if you've ever shared on your shows, the S&P 500 is what they would call a standard deviation of 1. That's the bar. That's what everybody measures against, is the S&P 500, right? It's top 500 companies. Well, an international manager is going to have a higher standard deviation. Small cap and mid cap might have higher deviations. Value is going to have a lower deviation over growth. Bonds are going to have a different deviation. So now when you put all these different components together and you squeeze the deviation, well, maybe you're at 0.7 or 0.8. Well, what does that mean? That means you should expect to get 70 to 80% of the performance of the S&P. So when somebody says, well, the market went up 20% and I only made 18, well, your deviation was 8. You should have made 16. We outperformed, didn't we? But they just see numbers. More importantly, again, I'm sure your listeners are hopefully in tune to, it's not what you make, it's what you keep. So the tax management side, as well as the not giving it back in the down market, which is why I'm big on the indexed annuities. There's zero downside risk, and you get participation on the upside. So if the market, you put your dollar, this is, Murphy's Law. So every investor out there is going to have an experience of the first time they put their money into something that dropped. And now they have to wait. And eventually they lose patience, they lose too much money, and then they go back to sitting in cash and they don't go back, right? Or as soon as they decide to get out, the market turns around and the stock comes back up and they're like, oh, why did I sell it? Well, because you don't know what the hell you're doing. That's why you sold it. Okay? So, but if a dollar goes to 50 cents, that's a 50% decline as people record their results. Well, do you need a 50% return? No, you need a 100% return to get back to even. A 50% return only gets you 75 cents, right? So if you drop, this is what I tell clients, pretty simple here. The market drops 50%, which I've seen it happen numerous times in my career. If an average return is 10%, it's going to take you 5 years to get back to even. Simple interest. Okay? Well, can you afford to lose those 5 years? What did you do to make money during those 5 years? All you did, if you were standing still, was claw back to even. Did you buy low? Did you buy more when it was down? When it was down 70%, 80%, 70%, 70 cents, 80 cents, on its way down to 50 cents, did you buy more? No, because most people tuck tail. They're like, well, I'm losing money in my 401k. I'm going to go finish my basement. I'm going to put in a pool. I'll put in a deck. Like they spent the money on something else because they didn't see the justification, because all it does is go down. They look at their statement for 3 years. All it did was go down. Yeah. Well, when there's a sale at the store, do you go in and buy more, or do you wait for the sale to be over and then pay for the premium? Don't you like sales? Raise your hand in the audience there. Who doesn't buy things on sale? Right? Doesn't Amazon have sales? Like Amazon has that Black Friday and Amazon days, and the stuff's on sale, right? They want you to come buy things. The $3,000 TV is $2,000. You want it. No, let's wait to go back to 3,000. Matter of fact, charge me 3,300 and I'm in. But that's how you treat your stocks, right? That's how most people treat their investments. Is when it goes down, they think it's no good. When it goes up, I'll buy it all day long. But now they're overpaying. So the key to success, what I've educated clients over the years, is you got to have that discipline. Asset allocation's the discipline, which lets you buy low. You add to your losers at the cost of selling your winners. And that's the rotation. Now, it's not 100% in and 100% out. It's pruning a tree. You want me to go down that rabbit hole? I'll keep going.
A little bit more. It's fascinating, yeah, because it sounds like you are talking about a whole portfolio, right? And you're trying to manage sort of how much money is in which bucket, because
Correct.
That is different from picking a single stock. Because when you pick a single stock, they tell you the opposite. They're like, stick with your winners, right? And as soon as it goes against you, sell it, right? But when you're talking about a portfolio, you have to watch, like, okay, I got this many percent in gold, or this much in like an ETF, this much in bonds, whatever, and you're trying to always move the money around in the buckets to keep it well balanced. If I'm understanding you correctly,
yeah, you are. Let's clarify a couple things. There's definitely a difference with stock purchasing and stock ownership versus mutual funds, and the average investor should really just stick with mutual funds because it has built-in diversification. But if you listen to the top money managers out there, whether they're managing American funds or it's Warren Buffett or most of them won't let an individual stock in their portfolio get above a certain percentage of the fund. And that tends to be in the 4 to 5% range. Now, it depends. Some of them are super aggressive and might have higher concentrations. That's a different animal. But most of them will prune. If you made big bets years ago in Apple and Google and Facebook, and they would have taken over your portfolio over your Coca-Colas and your General Motors and your IBMs and the lagging performers. But Netflix had a pretty precipitous drop recently, and I say recently, like the last year or so. Elon took a hit with the Twitter, the stock dropped. So the darlings will run into headwinds. Look, here's a simple lesson. Getting in is easy, getting out is hard. Okay? And so it doesn't matter when you get in, you're always going to be an armchair quarterback to woulda, shoulda, coulda. So you don't know when the best time to get out is. Time will tell. I mean, again, I'm going back into the 2007, 2008, when the market dropped and Apple went down as low as $75. And if you bought Apple at 75 when it had just dropped from 150, and if you do the math today, you got about a 30x on your money. But somebody sold at $75 for you to buy it at $75. Why did they sell? What made you buy? And then what kept you in it for the last 15 years to get a 30 times return on your money? And that's not the early Apple investors from the 70s. We're just talking 2008 when the market bottomed out in 2009, right? Am I doing the right years?
Yeah, that's right. You got it.
March of 2009. Okay. The S&P was 666, right? And so, that was the Mark Haynes bottom, they called it. But, that was the bottoming of the market. So, XM Sirius stock was like 5 cents. You know how many millions of shares you could have bought? But the fear factor takes over. Back to your question. If you own an individual stock, then you probably should have no more than 4% of your money going into that stock, which gives you 25 stocks. Well, if Apple's one of them and it doubled and it tripled and it quadrupled, it's now way more than 4% of your holding. So at what ratio in your discipline are you going to say is my threshold? So if they're all 4%, well, then you can't keep it at 4. It's got to be a bigger number. So if you have mutual funds, which is where most of this, really the majority of the listeners are going to be realistically, is in mutual funds. An asset allocation might have anywhere from 10 to 20 different components, right? If you just go by the stocks alone, international, small cap, mid cap, large cap, cut in half value, half growth. That's 8 right there. That's not counting cash. That's not counting bonds, gold, Bitcoin, or anything else. So if you just have equities, you got 8. Now, how much is in international value versus large cap value in the US versus mid cap, small cap, right? So the ratios aren't going to be the same from day one. You're going to have smaller components. But again, how did you determine that? Gabe, we're looking at 9%. Here's the ratio. Here's the mix to get to 9%. All right. Stay with me, see if I do a good job explaining.
Yeah, no, I'm with you.
So in my talks over the years, I'll use the car driving scenario and your cruise control as the explanation. So you're driving down the highway. The speed limit is 70. You have your cruise control set at 72, maybe 73, right? We'll just say slightly above the 70. Some people might be at 67. Some people might be at 82. So right there, what is that? That's risk. That's their risk tolerance. Little old lady, she's not going 70. She's sitting at 55, right? You're honking your horn at her. And then there's the guy in the sports car, and he's going 92. So whatever it is, you have your car set at your personal cruise control, 72. Well, that's your asset allocation. That's the risk that you've set your portfolio to. So that's day one you set on your journey. So now as you're driving on your car, what happens? Truck comes over, cuts you off. You're in the left lane. Truck moves over, cuts you off. You got to hit your brakes. You're now not going 70 miles an hour anymore. You had to slow down, let the truck get out of the way. He's probably passing somebody slower and cuts in and cuts back. So what do you do once the truck clears your lane? You hit the cruise control, you hit the resume button. Takes you back to 70 miles an hour. You got another car coming up. He's in the left lane. He's not moving over. You pull over to the middle lane. You hit the gas. You go 87, pass him and come back across. Do you want to stay at 87? No. You hit resume. You come back to your 72 miles an hour. So take the word resume, and now let's move it over to our pie chart of our asset allocation. When your portfolio shifts where it's no longer in alignment, you need to rebalance. So resume is rebalance. Well, what does that mean? Keep it simple. You have two items. They're 50-50 each. So forget the, 10, 12, 18%, mixes. You got 50% in this and you got 50% in that. Half in value, half in growth, half in bonds, half in stocks. Doesn't matter what it is. Can I put a disclosure? This is not investment advice. Okay. If your equities are outperforming your bonds, your equities are now 70. What's happened the last 10 years to bonds, right? Before this past year, bonds were 0 rates of return, right? So equities are killing it. Equities are up 50%, 30%. They've doubled in the last so many years. So if I'm 50-50, I have half my money in bonds. I'm retired. I got half my money in equities. But my equities are doing nice. My guy put me in some good stuff. She's got me moving. And all of a sudden, my million is $1.2 million. It's $1.3 million. But it's 500 bonds, and now it's 800 equities when it was 50-50. So what am I supposed to do at some period in time? My cruise control's what? I'm not balanced anymore. I'm not at 72 miles an hour. I'm flying higher because my equities moved up. I'm going to sell some of my equities. I'm going to rebalance it into the bonds. And now they're, what did we say, 800? So 650,000 each. So they both move to 650. But now on my cruise control, I'm back to 50-50, right, Gabe? Okay.
That's right.
Now what happens the next year? And equities have another great year, and bonds are still crapping out. And on and on and on. So you could do the same thing, value at growth, US and domestic, whatever it is. Well, eventually, 20 years later, bonds now made a move, right? So bonds just got clobbered, but now bonds are paying 7%, right? Or whatever, 5 or 6%, whatever the numbers are. But they went from 0, right? 10-year treasury was 0.75, and now it's like 4. So is that an opportunity to redeploy equity? Bonds just got clobbered. In this rising interest rate environment, bonds have been underperforming, stocks have been moving up. Well, isn't that a good time to prune some of your equities and grab some of those bonds that just got knocked down? And oh, by the way, your rates just tripled. So it's theory, right? This is theoretical, and it's not what happened in 2023, and it's not a predictor of what's going to happen in 2024. It's look at the history of stock market performances. Anybody out there listening, go Google the word quilt. Quilt sheets, quilt grids, I forget what they're called exactly. It looks like a periodic table from chemistry class. I was just saying, can we screen share on it?
I never heard about it. Yeah, I mean,
so when I used to do my seminars, the mutual fund companies would give out these. Now they're called quilt somethings. What it basically is, it's usually a 10 to 20 year historical performance of the asset classes, and it's colorized. And so you see the red box will be whatever, cash, blue box, yellow box, orange box, right? Brown box. That's why it's a quilt, because it's different colors. And everybody's color schemes will be different, but the bottom line is the asset class moves up and down as time goes by. And so when you look at the flow of the quilt grids, stock market quilt chart.
There you go. Stock market quilt chart. Okay, cool.
Try that. Try that, folks. So it's history, right? I'm an educator. My job is to help people understand what the heck's going on so they sleep and feel comfortable with what they're doing with their funds and their plans, right? So when you look at the quilt, by process of elimination, the data is right in front of you. I'm not pulling a rabbit out of my hat. If I tell you last year, 2 years ago, 5 years ago, blue was high, and I want you to sell blue and buy the bottom one, which was yellow, all you got to do is follow the color chart for those 20 years, and you see the blue one moving up, the blue one moving down, the yellow one moving up, the yellow one moving down. It's right there. The data's there. You go back 50, 100 years, I'm sure the data's sitting there. So using the quilt shows you how asset allocation and the rebalancing component will prove right over time to do what? Mitigate the risk. I didn't tell you to sell the blue. I didn't tell you to sell your Apple. But if Apple became 32% of your portfolio, is that really the right percentage? Look, you could be a big boy and make a big bet, big cojones, and live and die with it. Nobody's going to complain. It's your money. You do what you want. You want to go all in on Apple or Tesla or whatever it is that's made gazillions for people. Look, it worked for them, right? I mean, Gates made all his money in Microsoft, but look at those, look at Bezos, look at, Warren Buffett's and everything. They don't have 100% concentration in their companies. Bezos diversified, Gates diversified, Musk's diversified. They diversify when they have the opportunities. But did they make their billions first in their own company? Sure. But that's not an investor. They launched companies, right? And they had the inside track. They believed in their company, but they paid nothing for it. Okay. Yeah. When you're sitting in your 401k and you're trying to get to retirement, you're not making a big bet. Your wife going to hit you over the head. Your husband's going to hit you over the head. Right.
That's right. Yeah, I agree. I mean, your life is a single event, right? So probabilities are kind of out the window in the sense that it's a single event. If you make one mistake, it might take you 5, 10, 15 years to recover.
There's bricks behind you, right? And there's lines in those bricks. So there's a reason why Vegas and Atlantic City and the casinos do what they do. You can make a big bet and you can hit a home run. But at the same time, who's got the bigger house? You or them?
Yeah, they do. I mean, yeah.
Right? So the odds are in their favor. So
absolutely.
Statistically, making a big bet for the average investor is going to prove challenging. And, look, I'll never poo-poo anybody for having conviction and wanting to make an investment in something. The question is always going to be how much of their money should go into it. That's all I've ever challenged them on. How much of it are you willing to lose for that decision? Are you comfortable if you lost that amount of money? Is it going to disrupt your overall plan? Now, there are clients that we talked about covered calls, but there are clients that will play options, they'll play crypto, they'll play casino-esque investing styles. They have the FU money, then it's not going to change their lifestyles. Okay? We all have FU money. So Back in the day, it was comic books and baseball cards and coin collectors. And, you went back and you say, okay, now I got a few dollars. I'm 40 and I threw away all my Superman comic books and I want to buy them back. Okay, now I have FU money. I got a few dollars to play with, right? So just no different than you getting on a plane and flying to Vegas or, some casino junket somewhere, and you have a budget in theory. It's entertainment value. If I lose $3,000, okay, I'm a big boy. And sometimes I'll win, right? And I get a free room and shows and dinners and whatever. So it's entertainment.
Absolutely.
But that's not long-term investing.
It's not. And I agree. Like if you're going to have fun with, options or crypto or something, do it with a small amount of money so that if you lose it or if it goes against you or if your account blows up, it's not really going to have any big impact on your day-to-day life.
If you're constantly going back to zero, and I've made those mistakes. I was an options trader for my early parts of my careers, and I got lots of write-offs, But now you add up all the $2,000 or $3,000 losses you took over 30 years, and you're like, that starts to become real money. And if I had just put that money in Apple back then or something else, what would I have had? So the quick money isn't always the answer. Right. And it's hard to tell people that. And I'm a victim of that myself, even being an insider, because I was a player. I was a trader. I liked Vegas. I liked Atlantic City, and I liked stock options. Like, it was action. There's a gambling component to it. Right. Don't confuse that with investing.
Well said. Well said. And I dabble in options, and it's fun. And I fully
100%.
understand that it's entertainment much more so than investing. Yeah.
Quick stat if you don't know. Like 78% of all options expire worthless, right? I don't know if those stats have changed over the years. Okay. So if you're buying them naked, right, you're just playing and gambling, that you're got 22%, like 1 out of 5 are going to hit. Like, that's the statistic, right? It's 80% fail, which is why people sell covered calls or puts and sell the options, because 4 out of 5 times, it's like you being the landlord in the bank, and the property. You're just going to keep taking the money in, right? Every now and then, you get a bum, renting that house that didn't pay you and got to fix up the house and trashed it, right? So, but you get good tenants, your money's going to keep coming in. So if you buy the right stocks at the right timing, you do the right things, and you sell covered calls, you're just printing money. You do it in a tax-free account. You do it in a Roth. You're never paying money on that, right? So, there were a lot of disciplines in my early years that, we would do covered call strategies. We didn't have Roths back then, but, you put it in an IRA and you clip the coupons, right? You're taking a stock and you're adding an extra income component to it. Now you take a dividend paying stock at 5%, pick up another 2% in covered calls, with no movement in the stock, you're making 7% on your money. Like, people like that. You put it in a tax-free account, they're not paying income. So, again, it just pick your poison, right?
That's it. And this is not financial advice, but I'm curious about your opinion on cash. How much cash fits into one of those portfolios?
Cash in general will be predicated, I think, on people's age, needs, and did I say percentages? Percentage of the money in general. So cash is a non-performing asset, right? But there are people out there that like to know they have X amount of money they could always get their hands on, like literally in the closet or in the bank. And my wheels are spinning because the answer kind of ties into there's short-term, intermediate, and long-term goals. Well, a long-term goal is deemed to be 10 years or more. Why would you be in cash? An intermediate term goal might be 5 to 10 years. Why would you be in cash? A short-term goal, got to pay for my kids' tuition next semester. Oh, that should be in cash, right? So part of it is broken down into tell me when you need and when you need the money and where does it fit. So that's A. But over the years, I've had clients where part of the strategy was spending down cash over a 5 or 10 year period and liquidating their non-qualified accounts while their qualified accounts grew, tax deferred at higher risk levels, that basically if you made 7% in 10 years, you doubled that. So just think of it this way. You got $2 million and I got $1 million in cash investments, right? Non-qualified assets. And I got $1 million in my retirement plan. So I got 2 million. Well, we could spend down 100,000 a year with zero tax implications. Taxes are important, right? At the same time, make a 7% compounded return on my IRA. It's going to double that money back. I'll have $2 million over there. But for the first 10 years, I just spent $100,000. I bought a 1 year, 2 year, 3 year, 4 year, 5 year. Again, I'm just theoretically speaking. I bought 10 years worth of CDs at $100,000 a piece. And they got interest, right? I got 10 years worth of interest. I got 9 years worth of interest. right? So I get the cash flow from the interest of the CDs, and I can spend down the 100,000 as cash, no capital gains, no income. And so I get to stifle some of my tax liabilities, and I go from age 60 to age 70. Very little risk on that, isn't there? Now at 70, if I did my job right, the IRA now has $2 million in it. And I have all that residual interest that I made for the 10 years that maybe they banked or, did whatever. And then you just kind of start the same cycle all over again. So, again, we're back to planning. Tell me the timelines and use of money, and you start to map out when that's the biggest thing people probably get hung up on in getting to the retirement hurdle is, how do I now get at my money? How do I use it? What am I supposed to do? How do I keep it from imploding and not giving it all back? Because when I'm 40 and the market drops 40%, I'm not going anywhere. I'll just keep buying. I'm 67 and I'm turning on Social Security and I'm not going back. I can't afford to lose 40% anymore, right? So the risk tolerance have changed. So now you have to show them how they're going to dismantle their assets, whether they're living off the principal and never touching it, or do they actually have to start tapping principal, and how to do so, right? And then I use this line in my seminars: when do your lines cross? And I educate them on what that means. We don't have to go down that rabbit hole. They can come check out my webinars. But we talk about your lines crossing is knowing when you're going to start actually having to use principal. That's a whole 20-minute. You like my car?
Yeah, I know that's
fast lane asset allocation. But yeah, lines crossing is a whole conversation on understanding cash flow and when to utilize, where your money's going to come from, and how long your money's going to last, and how inflation rips at those heels. And you're back to your cash question again. Well, if inflation's at 7%, and my money's in the bank at 2%, am I really making 2%? No, I'm losing 5%, and I got to pay taxes on the 2%. Right.
Right. One last question.
Did we answer your cash question, Gabe? I don't know if I answered.
No, it's like it's fascinating because every time you answer my question, I think of 5 more questions I want to ask. But
we keep going. I'll come back
very, very quickly. I got an interesting question for you. When you sit with your clients, or when you sit with your clients, and you guys look at the planning, and your client says, "I'm here today. I want to be here." Let's say when I'm 55.
Yeah.
And you look at those 3 things that you talked about at the beginning, right? And okay, everything makes sense, but when I crunch the numbers, you need a return on your assets of like 10% or 11% or 12%. In your opinion, how high of a rate is just unrealistic?
Well, if you go by history, you're definitely stretching the historical rates of returns once you start getting past 10 and 11, right? Look, at the end of the day, my job is to help you understand everything and what you're embarking on, and set expectations. Because if you think for the next 20 years, you're going to just keep making 12% year in and year out to reach that goal, I'm going to show you history is against you. And we go back to those quilt grids or whatever they're called. And, here's the rates of return, right? So you can get any kind of published information anywhere, all these softwares. I mean, my time's come and gone in like the technology world with the E-trades and all those back testings and the grids and the graphs. Like, you can get data on anything you want these days. So any model allocation can be back tested. That's what a lot of them do. Right? When you buy life insurance and they give you a projected return, you buy an annuity, you buy mutual funds, they give you projected return. And what do they say in the big disclaimer? Past performance is no indication of future performance. But if we did what we did the last 10 years, you'll make this. Okay. Well, the last 10 years ain't the next 10 years. The last 10 years, we had zero interest rates with near zero inflation. You tell me what the next 10 years are going to look like. It ain't going to be that. It can't. It can't. Right? So you have to expect the unexpected. You have to expect the markets to go through ebbs and flows. You have to be prepared to protect your money, to not give it back. We started saying before, if you lose 50% of your money, it could take you 5 to 7 years just to get back to even. And now you've lost those 5 to 7 years. What do you do during that time? How proactive are you going to be to make money during that time? And by the way, buying and holding is still a decision. People don't want to sell because they don't want to make that decision. Holding something inappropriate is making a decision. It may not be the right decision. It might be time to get rid of that piece of garbage that's in your portfolio. If I've got a faster train, you got 2 trains to get to Baltimore, and one's going faster than the other, which one do you want to hop on? I want to go on the faster one. So if one's making 3%, I don't want to keep staying on that train and collect a dividend at 3% if Microsoft's, making me 18%. Like, let's move over there. So you have to, again, like anything else, I'm throwing individual names in the mix, but you get my point. Is like, you have to understand what your money's in, what it's doing, what you expect it to be doing, what are the economics around it. You mentioned gold and the Bitcoins. And again, I could have all kinds of conversations, in that opinion wise, but it's just measured. If all your money's in Bitcoin, shame on you. Like, just shame on you. And even the guys who've made billions, I guarantee all their money's not in it anymore. They liquidate over time. They have to diversify. We said Gates does. They all do it. So it doesn't mean it's a big piece of their portfolio because it grew into that and they let the horses ride. But day one, somebody didn't say, yeah, all in, 25 red at the roulette table and give it a roll. No. Black, red, and black, maybe, but that's 50-50 almost. So yeah, you just... Whether you're a real estate investor, you mentioned to me that you guys are into real estate. Do you buy all the houses in the same neighborhood, in the same state, in the same city? Or do you go across the country, you pick up something in New York, something in Florida, something in Colorado, something in California? Why? Diversify the markets. Got hurricanes in Florida. You got wildfires in California. Unfortunately, what happened in Maui, right? You thought Maui was safe. And how many people, just lost their homes there? Right? So if those are your properties, and by the way, you didn't properly insure them, and it's deemed a natural disaster, and the insurance companies don't have the money to pay you, you think you're getting your money out of those places? No. Hurricanes in Florida? No. People are going to eat it. So if you've got all your real estate tied up in those properties in those markets, you're going to be devastated, no different than somebody dealing with the stock market crash of 87 and 29 and pick any other market crashes, right? So it's diversification. That's the key. Big bets, big losses, but big bets, big games, right? So
absolutely. Yeah, Bruce, well said. I think you made a very, very good, passionate plea for diversification. And I think you're spot on. So thanks very much for sharing that perspective. Bruce, as we move to wrap up this fascinating discussion, hope that we can have you back on in the future and we can talk more about things like how people should plan for retirement, plan for death, estate planning, etc. I feel like we probably have all kinds of knowledge and expertise in those areas as well.
I got 37 years of stories, Gabe. Listen, this is somewhat facetious, but I say to people all the time when they ask me questions, right? My typical answer is depends, right? How do you do this? And what do you do with that? It depends. But my jokingly answer is, Gabe, you tell me when you're going to die, and I'll give you the perfect financial plan. Okay, right? Because so my client called the other day, like, when should I take my Social Security? Which is, a question for the ages, right? And I'm breaking it down, and we're talking about this, we're talking about that, and like it's a 45-minute conversation. And I threw that line in him. I'm like, look, a lot of information for you, right? He goes, yeah, I don't know what to do. I'm like, you tell me when you're going to die, and I'll tell you what to do. Because otherwise, it's a crapshoot, right? I mean, you got to make decisions with what you know. I don't know how long I could be gone at 62 and never collect my Social Security. I could live to be 102. And then, okay, deferring might have made sense, but I don't know.
And that's just it, right? I mean, I'm approaching episode 100 here. And one of the things I learned is that there is no one size fits all advice. Everyone's situation is different. Health, outlook on life, risk tolerance. I mean, everyone's situation is unique. That's why it's very hard to get one size fits all type advice. Yeah.
That's why my answer is depends. It depends. It depends. And you got to start from there.
So Bruce, tell us about your podcast and tell us where can people reach out to learn more?
Oh, thank you, Gabe. So the show's called Ask the Planman. You can come to my YouTube channel at planman.tv. Nice, short and simple. But anything in social media at Ask the Planman. I got 844 Planman phone number, Bruce at asktheplanman.com for email. But, you know, I got, the TikToks and the Instagrams and the Facebook and the LinkedIn, everything under Ask the Planman. You could always find me there. So, but yeah, please subscribe. I'm just looking for people to come follow the show. You're at 100. You doubled me up. I'm about to hit 50. So congratulations to you. And it's very self-help oriented. It's insurance, finance, and more. So we've got episodes talking about the different types of insurances out there: auto, home, commercial, pet insurance, disability, long-term care, life, keep going, right? Health, Medicare. But then I have episodes on what Wall Street doesn't want you to know. I have episodes on how your credit scores are built and managed, whether you should lease or finance a car. I have estate planning conversations, tax planning conversations. One of my attorneys set up a system because he has a special needs child. He created his own app called Hope Trust for special needs. 25% of American families deal with a special needs individual in their family. So he's tied in now with the Kennedys, with Special Olympics and all that. But he has his son's like 30 now. But when his child was born, being an estate planning attorney, his wife was panicking, like, what happens to the kid if something happens to us? And he's like, I'm in the business and I don't know how to answer that because there's so much that goes into it. And so he and his other son created a platform to house information that you would need, which, oh, by the way, can go to an elderly person as well when the family is non-existent, right? So, a widow, not a widow, a woman that never gets married or a person that never gets married, doesn't have children to take care of them, and the rest of their family dies off. Who's taking care of them when they're 97 in a nursing home? Who makes the medical decisions? Who handles the money? Who takes them? So think Rain Man. If those of you who have seen Rain Man, when Charlie Babbitt goes to take Ray, right? Take Ray out of the house, Dustin Hoffman out of his home, how disruptive it is, his routines. Well, that facility had his records of his routine. And Charlie doesn't know that routine, and he takes him out, and he's dealing with Wapner and the toothpicks and the screaming, and right. And eventually realizes, like, this guy's got to go back. Right? I can't. So I'm taking a tangent, but like, that's the kind of stuff that I have episodes on so that people can learn more about it, because you shook your head, your eyes kind of lit up a little bit, like, I didn't know that existed. I didn't know that's a situation. God, fortunately, you maybe didn't have a special needs situation in your life, but 25% of the audience is, in theory. So, I've had divorce attorneys on there, preparation for divorce, just do's and don'ts. So that's the kind of stuff that's on my show. So yeah, we might have boring conversations on health insurance, but then we've got things, I've got business coaches on there, franchising, there's that's why I use the term and more, because there's more than but it's about planning. Everything's about planning in different aspects. Business plan, if you're trying to start a business, if you want to be a franchisee, just whatever. So anyway, Ask the Planman.
Excellent. And I'll put that link into the show notes. And if any one of the listeners is familiar with the movie Rain Man, they're probably as old as us, Bruce, because that dates us. But great movie with Tom Cruise and Dustin Hoffman. Check it out if you haven't seen it. It's an absolute classic.
Like 1990, I think.
Something like that. Yeah, at least 30 years. Yeah.
Yeah.
Bruce, thank you very much for your time today. And I hope to have you back on the show at some point in the future.
Love to be back, Gabe. Thank you so much. Good luck to everybody.
Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.